we welcome in Jeffrey Gundlach. He's the DoubleLine founder, the CIO and the CEO. Welcome back. It's nice to see you.
Nice to be back again, Judge. This is our 41st post-presser interview, so the train keeps rolling. I thought that your introduction was spot on. I usually have a phrase of the meeting. I thought the phrase of this meeting was, "I got nothing for you on that." And not just on the political probing, which obviously he wasn't going to answer those types of questions, but just also pretty much the update on the markets, the economy, and the mandate. You know, I always start with the two-year Treasury when I think about Fed policy. Well, the Fed got in sync with the two-year Treasury with their last rate cut in December, and we're right on top of the Fed funds range. The two-year Treasury is at about 3.58, and the range for the Fed funds rate is 3.5 to 3 3/4, so 3 5/8 at the middle. So we're dead on there. And we've seen very little movement in rates since the Fed's last meeting. What's really happened, as I said earlier, the train keeps rolling on. We keep seeing the precious metals now being joined by commodities broadly, although since the metals, gold and silver and copper, are an important subset of the Bloomberg Commodity Index, obviously they're helping drive the index higher. But the Bloomberg Commodity Index is well above its nicely rising 200-day moving average. It has been now for a while, and commodity trends tend to be pretty gradual and long-lived, and they get frenetic, as we've seen in gold and silver. But commodities broadly are a strong performer in recent quarters, as are my favorite recommendation, which was local currency emerging market stocks and bonds, which have really done well, not only because those indices have outperformed, but as a dollar-based investor, you get a currency translation when the dollar's weak. And my central investment theme now, for about 2 years, has been center your portfolio positioning around the idea that the dollar is going to be secularly weak, even if the economy weakens, because it would lead to a fear on long-term debt, and we would continue to see dollar weakness as debt servicing comes into play. That's been the case since the last meeting. It's been the case for a while. One of the things, and our portfolios have been remarkably well positioned for this time period, largely because we've been sticking to this theme of dollar weakness and ultimately precious metal strength and foreign markets outperforming. One thing I'd like to talk about for your listeners is one of the things I've learned in over 40 years in this business. One thing I've learned is that the hardest thing to do when you've got a really good investment thesis is to decide when to change it. It's really hard, even if you've been really right, it's really hard to change. In fact, it's almost more hard to change when you're right, because you're being rewarded psychologically, you know, and economically. But I'd like to say that while we've been on the right track with this thesis, I have not made any changes to the way of structuring portfolios. In fact, the most recent moves I've made with my own personal money in asset allocation are to buy more gold miners back in June of 2025, which turned out to be remarkably lucky timing, and land. So I continue to like the idea of having real assets, things that will protect you from currency movements. And I saw a podcast with my friend, the great Jim Grant, and he said the price of gold is the reciprocal of investors' confidence in central banking. And I think that that's what's been going on with those metals. So, really good year last year for just about everything except oil and the dollar.
You made obviously a great call on what you thought the dollar was going to do. Well before on December 10th, when you told me again that you expected the dollar to weaken. I'm wondering what you make of the commentary over the last 24 hours. The president being asked directly about the weak dollar, in which he said the dollar is great. The Treasury Secretary this morning on this network said the U.S. always has a strong dollar policy. I'm wondering if this is one of the instances where you should look more at what they do than what they say, certainly in terms of what the Treasury Secretary said, because it appears as though they're very fine and happy with the fact that the dollar is doing what it is doing. What do you think?
Well, since they're so in favor of slashing interest rates further, I mean, I know the president says that repeatedly, and the Secretary of the Treasury has got on board with repeating that rhetoric. Since they want rates down so much, they've got to realize that that's going to weaken the dollar if the dollar is falling relative to other currencies due to we start slashing interest rates further when, as Jay Powell pointed out, there's really no reason to do so. But if you slash interest rates, then you're not only running a weaker dollar policy, but you're running an inflationary policy. So I continue to like this idea, although it's a very crowded trade now. We started this 2 years ago plus, thinking that the long end of the yield curve was not going to do well, that the dollar was going to be weak as the interest rates would be cut sequentially, and that continues to work. But I do notice that long-term interest rates have stabilized, just like Jay Powell pointed out that the unemployment rate has somewhat stabilized and that the dual mandate isn't in so much tension as it was in the second half of last year. I felt like this was almost an echo of some of the commentary last January, which I thought was Jay Powell's best ever attitude. He was really feeling it. He really thought sincerely, he articulated that policy was in a really good place, that the dual mandate was back in sync. Inflation was falling, unemployment was low. And that got kind of blown up in the second half of last year as inflation proved to be stickier and coming down slower, and the unemployment rate started rising. But now he's talking about less tension between both sides of the mandate, and I really agree with that. And I think he's setting the stage. He only has 2 more meetings. I would bet pretty heavily that there's not another rate cut under Jay Powell. I think he's going out of his way to emphasize that inflation is a little elevated, but not as bad as maybe it was feared a few months ago, that the unemployment rate is no longer, it's not really rising in any kind of meaningful way. And that being supported by the fact that while there's not much job growth, there's not really labor force growth either. So it's in balance, as he pointed out correctly, in kind of a strange way. So I'm not surprised that markets aren't doing that much year to date. But once again, in this first less than 1 month of 2026, what's outperforming? It's the precious metals, it's commodities, it's non-dollar markets, particularly local currency emerging markets, which is really one of my strongest recommendations. So I still recommend a relatively small allocation, maybe 30 to 40% stocks, but all of them basically. I know this is risky for dollar-based investors, but I have conviction on this. All of them should be in non-dollar markets in the non-dollar currencies. I think that's going to continue to be a winning trade. I wouldn't put 70% in something like that. I still like what's performed well. Bonds did well last year, particularly really credit bonds did well. Their spreads came in. Interest rates broadly created gains in bonds, not so much for the long bond, but particularly for the belly of the curve that we're involved in. I still like that strategy. I'm not changing anything. Spreads are very tight versus treasuries, but there doesn't seem to be so much risk at this moment at these spread levels as we might have been concerned about in past periods, because I believe a lot of the risk in the public bond market has been absorbed by the private credit market, which continues to have headlines that are showing up with kind of a drumbeat of deterioration in results, not performing public credit anymore, private credit isn't. And we're starting to see write-downs of some alarming magnitudes, which I think will be plaguing that industry in 2026. So I greatly favor public markets over private markets. I have for about 18 months, and I think that's going to be a major theme over the next year or two.
Jeffrey, what do you make of this investigation into Chair Powell and the Fed? What do you make of the unprecedented manner in which he responded to it a few weeks ago, and then the advice he gives to whoever his successor will be? Stay out of elected politics. Don't do it.
Well, it just seems part of where we are right now societally. I mean, we've got all kinds of people making all kinds of videos and making all kinds of threats against other people. It's just a bad moment for that, and I think Jay Powell got himself caught up with that and regrets it. I think a lot of people putting out these videos probably regret it. So it's just a sign of the times. What's interesting, I thought Steve sort of alluded to the helm of the ship. I think that one of the things that made Jay Powell seem sanguine, I like that word that you use, sanguine, is that the GDP now has come out at surprisingly strong levels. I mean, a few months ago, we were worried about unemployment, And now we've decided that we have an explanation for that because of the global balance of no hiring, but no labor force growth. But GDP now, GDP during 2025, the first quarter was officially negative on a real GDP basis. And then it turned positive in Q2, and then got even better with a 4 handle, at least that's where it is now. It might get revised in Q3. And now GDP now of the Atlanta Fed is at 5.4 for the fourth quarter. Now, that might be a little early, but if you put that all together, if we go with that 5.4 GDP now and use the numbers as they stand presently for the first 3 quarters, real GDP for 2025 will be 3.2%. Nominal GDP will be 6.3% if the inflation forecasts are right. So the GDP deflator, that means, would be rising over 3%. That is an elevated level of inflation versus a 2% target. And we've been going on for 5 years now with inflation above 2%. And if inflation runs at 3%, which is what it's running at now, over a 15-year period, you would have a 56% increase in the price level. If you run at 2% over 15 years, you would be up only 35%. So 1% difference doesn't sound like much. When you accumulate it over a not terribly long time period of just 15 years, you end up getting over a 20% difference in the level of the price rate. So there is a big difference between 2 and 3%. So we do have an elevated level there. But if you look back at the past 5 years, the inflation rate has been 3.9%. So that's what people are still feeling when it comes to inflation. They feel that prices are elevated. Yes, gas has come down. That's in parts of the country, it's come down phenomenally. You no longer hear about the price of eggs. Egg prices are lowest they've been as low as they've been any time in years. But still, you have the K-shaped economy, which is undeniable. We look at GDP and it looks great, but it's pockets that are doing that. You know, it's a lot of this of business investment with AI build-outs and the like, and it's a lot of high-end consumer spending. So I like to admonish investment analysts to say, don't always just look at aggregated data, because as the economy gets so much more bifurcated and new technologies catch people's imagination and have a lot of CapEx investment, that doesn't mean that just because on average things are doing well, there's a huge dispersion as you go quartile by quartile or quintile by quintile, decile by decile in people's actual circumstances. And it's that piece of the puzzle that explains all these things I talked about earlier about people not getting along and videos that people end up regretting. And unfortunately, that's going to be the legacy of these economic policies that revolve around deficit spending. So I think that we need a significant reset on the way this economy is operated, and we're starting to see signs that might be becoming more probable. We go all the way back to Liz Truss with the blow up in the gilt bond market when they started to run indications they were going to run even higher and higher deficit spending. The bond market collapsed. And then we saw a revolt last week in the Japanese 40-year bond market where the yield went up 25 basis points in a day. And then all of a sudden, the intervention comes in. And so I think we're getting closer and closer to that moment where intervention becomes more of a choice on the menu of government policies. And that's why one reason that although I'm negative on long-term Treasury bonds still, even though that trade has stalled out for the time being, I'm thinking more and more about what will happen if those rates continue to be stubborn. Will they try to get those rates down to stimulate the affordability of housing, maybe lower the interest expense on the debt? And what would that mean? Well, what it would mean is potentially a very violent rally in the long-term part of the Treasury bond market. I'm not positioned for that. I don't intend on positioning for that this week or this month exactly, but it's becoming more and more of an issue that something funny is going to happen with government finances and the financing of the bond market. And we've seen tells on this building up over the past 5 years.
You know, it's interesting that you went there because I wanted to ask you more specifically about it. If you look at what's happened with the spike in Japanese yields, there was an interesting piece, I thought, this week from BlackRock in which they suggested that bonds are no longer a safe hedge. That's how they put it, and they looked at the historic spike in Japanese yields. they try and extrapolate from there and suggest that it's a global story. And I think you may agree with this. You have the threat of more tariffs. You have obviously where the deficit is. You have a surge in corporate bond sales, partly tied to the AI build out. A lot of leverage in the system as a result of that in and of itself, which has exposed the financial system to shocks just like what happened in Japan and could easily happen elsewhere, to which they are tactically underweight long-term Japanese bonds and also long-term U.S. treasuries, just like it sounds like you are, and have real no impetus to change that philosophy or investment idea anytime soon.
Well, they must be reading my stuff, Scott, because I've been on this theme for a long time and positioned that way for a long time. And I agree with that completely. In fact, I think there's tremendous evidence for this because the dollar does not act like a safe haven currency, and it hasn't for a while now. I talked about this in past appearances. Since 2000, there have been 13 corrections or more than that in the S&P 500. The first 12 times that happened, every single time, the dollar went up by about 8 to 10% on average. Every time, 12 in a row. Last March, April, when the S&P went into a significant correction, the dollar did not go up. It went down 8 to 10%. And what we see as a safe haven appears to be tangible assets. Obviously, gold and silver, not Bitcoin. Bitcoin's down over the past year. It's fascinating that with all the enthusiasm and sort of star power allure that Bitcoin had for such a long time, it's fascinating that we could have a 90% rally in gold over the past 12 months and Bitcoin is down. I think that's a sign of something. I think it has to do with these opaque private markets that seem to be running into incremental trouble. I think that the people, investors, are starting to look for things that are real. They're more interested in things that are real, and they're getting more sober about things that are hype. And I think that that's going to be an accelerating trend, and it's already well underway. And that train just keeps on rolling, as I've said twice now already.
Right. Let me lastly, by the way, I'm assuming that the new roundtable prime that you've done, which is your annual conversation, if you will, or plural, with some market thought leaders, explores a lot of that. Let me ask you this, because the prediction markets are abuzz with who's going to be the next Fed chair. I mentioned what Jay Powell said about his advice to the next one: stay out of elected politics, don't do it. If they called you and said, who do you think will be best in that seat following Chair Powell, of Mr. Reeder and Warsh and Waller and Hassett, what would you say?
I think I would go with Waller. I think he's less likely to be manipulated. But you mentioned the roundtable prime. We have Jim Bianco has been on the roundtable prime for years, and we were talking about Fed chair there, and he said, I don't care if it's Kevin Warsh, Kevin Hassett, or Kevin Costner. And I thought that was pretty funny. But the roundtable prime is up for replay at DoubleLine.com, and it doesn't take forever to watch. You can watch it in about an hour and a half, and you can certainly skip around. And I thought it was the best roundtable prime we've had, having done it for about 8 years. So thanks for bringing that up. But I don't really have an opinion that much about a Fed chair. I want somebody that's strong. I want somebody that wants to have fiscal rectitude. And I don't know exactly if any of these would fit the bill for that. But I'm a steward of other people's money and my own wealth. And so I can't control what's going to happen. All I can do is try to think about it and prepare and make moves based upon who ultimately gets selected and how they start to approach the rhetorical part of being Federal Reserve chairperson. I'm not really worried about any of these people. I'd be worried about Myron. I think we would be running a very weak dollar policy, and we would be running into a very significant inflation policy if we were slashing interest rates to below the inflation rate. I think that would be a huge mistake.
Well, he was a dissenter today, along with Mr. Waller. They wanted a quarter-point cut. Yeah. So we shall see, and it's always good to talk to you and get your up-to-date investment advice, as always. Jeffrey, thank you. We'll see you after the next meeting.
All right. Good luck, everybody out there. Thanks, Judge.